Continuation of Chapter 3, Rules of Professional Conduct. Section 2.3, Safeguarding Independence. The responsibility of safeguarding independence is shared between the individual auditor and the profession as a whole. The responsibility of individual auditors and audit practices. There should be a culture of independence and a belief in auditors' independence that is shared by all partners and employees in an audit firm. It has been suggested by some commentators that detailed rules and regulations to preserve independence can be avoided if all auditors accept the concept that a good auditor is an independent auditor. Where possible, there should be rotation of the engagement partner. The partner, that is the partner in charge of the audit and of senior staff. Rotation means that an individual should not be involved in the annual audit of the same client company for more than a maximum number of years. In addition, an audit firm should have the following procedures in place. 1. Appropriate training, including training in how to maintain an independent opinion during audit work. 2. Quality control procedures. A firm should have procedures for quality control to ensure that independence is considered in respect of all work undertaken by the audit firm. 3. Consultation procedures. A firm should have internal procedures for consultation, whereby questions arising in relation to independence can be discussed. If an auditor becomes aware of a situation that may be seen to threaten his independence, appropriate action should be taken to resolve the issue. The action to be taken will depend on the circumstances, but might include any of the following. 1. It may be possible to remove the threat to independence by a simple action, such as not accepting an offered gift, or for an audit partner to dispose of shares that he holds in the client's company, and so on. To dispose of shares that he holds in a client's company, and so on. Sometimes it may be necessary to reject a proposed appointment as auditor. For example, an audit firm may have to reject its appointment as auditor of a new client company where the guidance on fee income level would be breached, because the new fee income from the client would exceed the maximum limit established by the professional guidelines. With an existing client, if an independence issue cannot be resolved, the ultimate action is to resign from the audit of the client. The responsibilities of the profession. Professional bodies expect their members to comply with codes of conduct relating to independence and will take disciplinary action as appropriate. Such action must lead to a fine, reprimand, or exclusion from membership. The profession and other interested parties regularly suggest new practices and procedures designed to improve auditors' independence. Suggestions have included: 1. The regular rotation of auditors to avoid too close a relationship developing between the auditor and the client over a long period of time. 2. The use of audit committees. The responsibility for safeguarding independence is seen as shared between the individual auditor and the profession as a whole. Section 2.4. The provision by auditors of non-audit services. The provision by auditors of non-audit services. In addition to the provision of accountancy or valuation services considered above, the Code recognizes that there may be or there may appear to be a threat to objectivity and independence where the auditor provides additional non-audit services to the client. Such non-audit services might include accountancy services and services in connection with preparing the financial statement, taxation work, the outsourcing of internal audit services, IT work, consultancy assignments. The provision of non-audit services is now common among audit firms of all sizes. Most auditors recognize the potential threat to their independence, and they try to deal with the problem through their internal organizational structure. Large firms will operate in a number of separate departments, each with its own partners and members of staff. By dividing the work of the audit firm into different functions, employees involved in audit work will not be the same as those involved in providing, say, consultancy advice to the same client. In some of the largest practices, the consultancy department has been legally separated from the accounting or audit arm of the firm as a further step toward preserving auditor objectivity and independence. A similar approach is often taken by smaller audit firms. Although these firms may not be large enough to be organized in separate departments, efforts are usually made to ensure that different members of staff and partners are responsible for different services provided to clients. Example, non-audit work and safeguards. An audit firm has completed the annual audit for a client company, and the audit team has identified a number of weaknesses in internal control that have been notified to the client management. As a result, the client has asked the firm to carry out a review of its financial IT systems. What are the ethical issues to consider in this situation, and how might the problems be dealt with? Answer. The engagement would involve non-audit work. The audit firm can accept this engagement subject to certain conditions. The management of the client company must recognize that they have the responsibility for internal controls in the company. This responsibility cannot be passed on to the auditors. The engagement team will not be required to act in a management capacity in any way. For example, they must not be given any responsibility for the implementation of any improvement in internal control that they recommend. There must be sufficient controls against self-review threats. For example, the individual assigned to the engagement team to do the work should not include anyone who will also be a member of the audit team. ICAN Code of Ethics Guidance on Providing Non-Audit Services. The code recognizes the value to both client and auditor of the provision of non-audit services, but requires the auditor to evaluate the significance of any threats to independence created by the provision of such services. In some cases, it may be possible to eliminate or reduce the threat by applying safeguards. However, ICAN considers that safeguards are not possible for the following activities. 1. Authorizing or executing a transaction, or otherwise exercising authority on behalf of the assurance client, or having the authority to do so. 2. Determining which recommendation of the firm should be implemented. 3. Reporting in a management role to those charged with governance. All the above activities involve the auditor or audit firm in assuming a management role. ICAN considers several specific areas of non-audit service provision. Most of these activities are considered permissible, provided that 1. Management decisions are not taken, and 2. Appropriate safeguards are put in place. Some of these areas are set out below. 1. Taxation services. Routine compliance, planning, and advisory work on taxation is generally permissible, subject to the condition that the auditor must not make management decisions. 2. Internal audit services. Internal audit services may be provided by an external audit firm if there are appropriate safeguards, e.g., use different teams for internal audit services and the audit, on condition that the auditor does not act in a management capacity and that the client acknowledges its responsibilities for internal control. 3. IT system services. IT system services are permissible with appropriate safeguards. The client must acknowledge its responsibility and make all management decisions. Litigation support services. Such services may include acting as an expert witness, calculating estimated damages, assistance with document management and retrieval, and could create a self-interest threat, depending on the materiality of the amount involved and the subjectivity of the matter concerned. Safeguards might include 1. The service not being performed by a member of the assurance team. 2. The firm having policies and procedures such that an individual is prevented from making any management decision on behalf of the client. 3. The involvement of independent experts. Legal services. The threat will depend on the nature of the service, whether the provider is also a member of the assurance team, and the materiality of the matter. Safeguards are likely to include those listed under general non-assurance services above. However, the code states that acting for an audit client in the resolution of a dispute or litigation where the amounts involved are material to the financial statement creates such significant advocacy and self-review threats that the work should not be taken on. Recruitment of senior management. The recruitment of senior management for an assurance client may create current or future self-interest, familiarity, and intimidation threats. The level of the threat will depend on the role of the person to be recruited and the type of assistance sought. Section 2.5. Commercial transactions between an audit client and a member of the audit team. The code does not prohibit commercial transactions between an audit client and a member of the audit team, provided that they are made in the normal course of the client's business and they are at arm's length. In other words, they are made on normal commercial terms and the value of the transaction is not material to either party. Example, commercial transaction with an audit team member. An audit firm has a client company, Zoomco, which operates a motor racing circuit. The audit firm has discovered that the audit manager for the Zoomco audit keeps a racing car at Zoomco circuit and uses the race track regularly. Because he is the audit manager, Zoomco allows him 50% off normal charges for garaging the car and for use of the racetrack. What is the ethical position and what measures should the audit firm take to deal with this situation? Answer. The transaction between Zoomco and the audit manager is a normal commercial transaction for Zoomco. But it is not at arm's length because the audit manager gets 50% off normal prices. The transaction may not be material for Zoomco, but it is likely to be material for the audit manager. Consequently, there has been a breach of the ethical code by the audit manager. The audit manager has created a self-interest threat and possibly a familiarity threat by entering into the transaction with Zoomco. 1. The ethics partner of the audit firm should be consulted and asked to assess the materiality of the transaction between Zoomco and the audit manager and to consider whether disciplinary action is appropriate. 2. The audit manager should be removed immediately from the Zoomco audit team and replaced by someone else. 3. Those charged with governance of ZUMCO, that is the board of directors or the audit committee, should be told about the action that the audit firm has taken and the reasons why the action was necessary. 4. In view of the threat to the objectivity and independence of the former audit manager, the audit plan for the ZUMCO audit should be reviewed and amended if this is considered necessary. The ethics partner may also wish to check whether the former audit manager has entered into commercial arrangements on favorable terms with any other audit client. Section 2.6. Making referrals. An audit firm may enter into an arrangement with another entity, whereby the other entity agrees to pay a fee to the audit firm for referring clients. For example, a software company may specialize in selling accounting software packages or writing bespoke accounting software. It may enter an arrangement with an audit firm whereby the audit firm will receive a fee every time that it refers a client to the software firm with a view to buying a software package or software services. This type of arrangement would create a self-interest threat for the audit firm. However, it is permissible provided that suitable safeguards are in place. Suitable safeguards would include the following. 1. When making a referral, the audit firm should notify the client that it will receive a fee for the referral. This means that the client will be made fully aware of the financial benefits for the audit firm. 2. The audit firm should monitor the quality of the products or services provided. In the case of referrals to a software company, this means having to keep the quality of the software packages and services under review to make sure that they meet appropriate standards. It is important that audit clients should not be referred to someone who provides poor quality goods or services. 3. The firm should also obtain verification from all staff involved with the audit of a client who is referred that they do not personally have any financial interest in the company or other entity to which the referrals are made. Furthermore, a chartered accountant in practice may purchase all or part of another firm on the basis that payment will be made to individuals formerly owning the firm or to their heirs or estates. Such payments are not regarded as commissions or referral fees. With respect to obtaining new clients, paragraph 7.1.5 of ICAN's Code of Ethics states that in Nigeria, a chartered accountant in public practice should not pay or receive a referral fee to obtain a client. For example, where the client continues as a client of another chartered accountant in public practice but requires specialist services not offered by the existing chartered accountant, the payment of such a referral fee may also create a self-interest threat to objectivity and professional competence and due care. Section 2.7 Illustration. Further examples. Threats to independence. A Nigerian audit firm, Tire and Sleep, is faced with the following situation. Situation 1. Mr. Tire is one of the audit firm's partner. He and his wife have been invited by the managing director of Entity X to a weekend celebration in Cape Town to mark the 20th anniversary of the incorporation of Entity X. Mr. Tire has been the engagement partner through this time. Situation 2. The firm has been approached by the director of Entity Y with a view to being appointed as auditors. One of the firm's audit manager, Mr. Knapp, is company secretary of Entity Y, although he takes no part in its management. His parents are the sole directors and shareholders of Entity Y. Situation 3. The finance director of Entity Z a private limited company, has requested that only certain staff are to be included in the audit team to prevent unnecessary interruption to the entity's accounting department during the audit. In particular, he has requested that David, who has been the accountant in charge of the audit for the last 2 years, be assigned to the audit and that the team contain no new trainees. Required. What threats to objectivity are present in each of these situations and how should the audit firm deal with them? Answer. Situation 1. The fact that Mr. Tyre and his wife have been invited to a free weekend in Cape Town represents a threat to the firm's independence, because it would be perceived that they are too close to Entity X and therefore not truly independent. The offer should be refused as goods. The offer should be refused as goods, services, or hospitality should only be accepted when the value is clearly insignificant, which it is not to Mr. Tyre and his wife. Even if the invitation is declined, there is a potential problem with regard to the length of time that Mr. Tyre has been the engagement partner, 20 years. He is by now likely to be over familiar with the client and may be too trusting and or sympathetic. The firm should strongly consider safeguards to independence in this situation, such as rotating Mr. Tyre away from this engagement. Situation 2. Mr. Knapp takes no part in the management of Entity Y. However, if he is involved with the audit, there may be actual or perceived threats to his objectivity, as his immediate family members, his parents, are the directors of Entity Y. The firm must ensure that Mr. Knapp is not part of the audit team and is not in a position to influence any members of the audit team. If this cannot be demonstrated, then the firm should not accept the audit engagement. Situation 3. The key ethical issues that arise in this situation are familiarity and possible intimidation. There is a risk that if David is assigned to the audit over too long a period, he might become unduly familiar with the client and its staff and lose his objectivity in relation to the assignment. The finance director's request could amount to intimidation if there is any question that the audit would be withdrawn if the request was not complied with. Best practice is that audit firms should not allow clients to dictate staffing issues, as it is important that audit firms staff their teams in the most appropriate way in terms of safeguarding against ethical threats, quality control on the audit, and technical expertise. If the firm considers it not appropriate to comply with the finance director's request, they should not do so, while assuring him that if different staff are assigned, they are required by professional standards to have obtained a good knowledge of the business and to be directed, supervised, and reviewed well, hopefully therefore causing minimum disruptions to operations. Subtopic 3. Confidentiality and conflict of interest. Section 3.1. The basic principle. The ICAN Code of Conduct applies IFAC's Code of Ethics regarding confidentiality. In both codes, the duty of confidentiality is a fundamental principle of professional behavior, that information obtained in the course of professional work should not be disclosed to others or used unless 1. Disclosure is permitted by law, and consent has been obtained from the party to whom the duty of confidentiality is owed, or 2. Disclosure is required by law, or 3. There is a professional duty or right to disclosure when not prohibited by law. Part of the rationale behind this requirement is that auditors need full and frank disclosure of information from a client in order to carry out their duties. If the client is not assured of confidentiality of this information, he may be unwilling to provide all relevant information to the auditor. Each of these three situations is discussed in more details below. Section 3.2. Recognized exceptions to the duty of confidentiality. Disclosure permitted by law and authorized by the client or employer. For example, 1. When an auditor is asked to report to a bank in relation to compliance with a loan covenant, the auditor will seek the client's authorization before disclosing confidential information to the bank. 2. When an auditor is asked to report to a listing authority, that is stock exchange, in relation to listing rules, again, the auditor will seek the client's authorization before disclosing confidential information to the listing authority. Disclosure required by law. An ICAN member may be required by law to disclose confidential information to an appropriate legal authority. In such circumstances, the requirements of the law override the duty of confidentiality. The ICAN Code of Conduct provides the following illustration of when disclosure is required. 1. Producing documents or other evidence in the course of legal proceedings, or 2. Disclosure to the appropriate public authorities of infringement of the law that come to light. One specific example is money laundering, where an ICAN member is required by law to make disclosure to the relevant legal authorities if he knows or has reason to suspect that a client has committed terrorism, drug trafficking, or any other money laundering activity, or any other money laundering activity. Note that the Money Laundering Act requires an accountant to report mere suspicion of money laundering, even if those suspicions ultimately turn out to be false. The accountant remains protected by law from being sued by the client. Professional duties or rights to disclose when not prohibited by law. Disclosure of confidential information is also permitted when an accountant has a professional duty or rights to disclose when not prohibited by law. The ICAN Code of Conduct gives a number of illustrations of when this applies. 1. To comply with the quality review of a member body or professional body. 2. To respond to an inquiry or investigation by a member body or regulatory body. 3. To protect the professional interest of a chartered accountant in legal proceedings. For example, when it is reasonably necessary to protect the interest of the member in making a defense against an official accusation of professional negligence. 4. To comply with technical standard and ethics requirements, or 5. Other similar situations not covered above. Other considerations. In deciding whether or not to disclose confidential information, chartered accountants should consider the following points. 1. Whether the interest of all parties, including third parties whose interests may be affected, could be harmed if the client or employer consents to the disclosure of information by the chartered accountant. 2. Whether all the relevant information is known and substantiated to the extent that it is practicable. When the situation involves unsubstantiated facts, incomplete information, or unsubstantiated conclusions, professional judgment should be used in determining the type of disclosure to be made, if any. And 3. the type of communication that is expected and to whom it is addressed. In particular, chartered accountants should be satisfied that the parties to whom the communication is addressed are appropriate recipients. It is possible that a member may be in doubt as to whether he has a right or duty to disclose information. Under such a circumstance, they should seek legal advice or consult with ICAN for advice. Section 3.3 Improper use of information. An ICAN member should not use or appear to use confidential information gained in the course of professional work for his personal advantage or for the advantage of a third party. For example, a member should not deal in the shares of a client's company in such a way that it might seem that information obtained in a professional capacity has been used for his personal advantage, so-called insider dealing. Where a member has confidential information from client 1, which affects an assurance report on client 2, he cannot provide an opinion on client 2 that he already knows from this other source to be untrue. If the member is to continue as auditor to client 2, he must carry out normal audit procedures to enable the same information to be obtained from another source. Under no circumstances should there be any disclosure of confidential information outside the firm. Ultimately, the auditor may have to resign. Section 3.4 Confidentiality of working papers. An accountant's working papers which contain confidential client information are the property of the accountant and should not normally be made available to outside parties. However, situations may arise where government agencies, for example, tax authorities, ask to see the accountant's working papers relating to a particular client. In such situation, the accountant should act in the best interest of his client. If he feels that releasing the papers is in the best interest of his client and the client has no objections, then the paper should be made available. Ultimately, the tax authorities are likely to have legislative power to obtain the papers. Any lack of cooperation on behalf of the auditor or his client may add to any existing suspicions. Occasionally, the authorities may ask to see a sample of working papers from a firm of accountants, but not in relation to any particular client. This may occur when the authorities have doubts about the quality of the work performed by that practice. Again, a best interest approach should be adopted, allowing the authorities to review the papers if the accountant judges that this is in the best interest of the practice and its client. An appropriate practical compromise may be achieved in this situation by arranging for an independent accountant to review the work and issue a report to the authorities. Section 3.5 Conflict of interest. Conflict between members and clients. ICAN members of firms should not accept or continue an engagement where there is a conflict of interest between the member or firm and its client. The test is whether or not a reasonable and informed third party would consider the conflict of interest as likely to affect the judgment of the member of the firm. Example of this might include when members compete directly with a client, the receipt of commission from a third party for the introduction of a client. For example, an accounting firm may be paid a commission by another entity, such as a firm of brokers, for introducing the entity to its client companies. Safeguards. Accountants should have procedures in place to identify possible conflict of interest situation, evaluate the possible problem, and where necessary, take action to manage or avoid the conflict. Possible procedures include the following. 1. Review relationships with all clients on a regular basis. 2. Take care to consider potential conflict of interest when deciding whether or not to take on new clients. 3. If a potential conflict is identified, decide on an appropriate course of action. An appropriate course of action may be any of the following. Notify the clients involved and discuss the matter with them. Set up Chinese walls to manage the problem. A Chinese wall is set up by using different members of staff on the assignments for each of the clients and locating them in different offices. The two groups of staff act independently of each other and do not communicate with each other except in an official capacity. Consider resigning or declining the new engagement offered in respect of one of the two competing clients. Conflict between competing clients. A firm might act for two clients that are in direct competition with each other. The firm has a professional duty of confidentiality and so will not disclose confidential information about one client's company to its competitor. Again, the test is whether a reasonable and informed third party will consider the conflict of interest as likely to affect the judgment of the firm. The approach that the accounting firm should take will be a matter of judgment and should reflect the circumstances of the case. Where the acceptance or continuance of an engagement would materially prejudice the interest of any client, the appointment should not be accepted or continued. In other cases, possible safeguard might include the following. 1. Giving careful consideration to whether or not it is appropriate to accept an assurance engagement from a new client that is in direct competition with an existing client. It may be appropriate to decline the offer from the potential new client. 2. Careful management of the client, for example, by ensuring that different members of staff are used on the two engagements. 3. Full and frank disclosure to the client of the potential conflict, together with suitable steps by the firm to manage the potential conflict of interest. 4. Procedures to prevent access to information such as physical separation of teams and confidential and secure data filing. Such an approach is known as creating Chinese walls. 5. Establishing clear guidelines on security and confidentiality and the use of confidentiality agreements. 6. Regular review of safeguards in place. 7. Advising one or both clients to seek additional independent advice. Subtopic 4. Corporate financial advice. Section 4.1. Introduction. Certain types of corporate finance services may create such significant advocacy and self-review threats that the work should not be taken on. Assurance firms should not promote, deal in, or underwrite an assurance client's shares. Commit an assurance client to the terms of a transaction or complete a transaction on an assurance client's behalf. In other cases, safeguards such as not making management decisions and using individuals who are not members of the assurance team should be considered. Section 4.2. Advising clients involved in takeover bids or share issues. Auditors are often asked to give advice. However, where clients are involved in a contested takeover bid, the auditors could find themselves in a position where they are potentially acting for both parties. In this situation, there is a danger that the firm cannot give objective professional advice in the best interest of both parties. That is a possible lack of independence. 2. The firm may be in possession of confidential information relating to each party, with a risk that the information may inadvertently become available to the other party, that is a possible breach of confidentiality. Guidelines in these areas are as follows. 1. There is no reason in principle why firms should not act for both parties when a contested takeover bid occurs. However, a firm should not be the sole or main advisor to both parties. 2. If the accountants are in possession of material confidential information and feel that their position in this respect is questionable, they should take advice from the appropriate financial regulatory authority, for example, the stock exchange involved in the takeover of the national regulator. For example, the stock exchange involved in the takeover or the national regulator of the financial market. Similar conflict of interest may arise in connection with issues of shares to the public, because the accountant may be advising both the company issuing the shares and potential investors, such as companies interested in buying an investment in the shares or investment institutions. Subtopic 5, Chapter Review. Before moving on to the next chapter, check that you now know how to 1. Describe the fundamental principles of the IFAC Code of Ethics. 2. Apply the conceptual framework to identifying threats to the fundamental principles and suggest appropriate safeguards across a range of common scenarios. Quick quiz questions. 1. In which of the following situations would an auditor be required to disclose confidential information about a client to the authority? 1. Suspicion of terrorism. 2. Suspicion of tax evasion. 3. Suspicion of money laundering. 4. Suspicion of drug trafficking. Options 1, 2, and 3 only. B. 1, 3, and 4 only. C. 2, 3, and 4 only. D. 1, 2, and 4 only. The answer is B. For certain suspected crimes, the requirements of law override the duty of confidentiality. Question 2. Which of the following statements is incorrect? A. Internal audit services may be provided by an audit firm for an audit client, provided that the audit firm can take on the responsibility for internal controls. B. To protect its independence, an audit firm should have internal consultation procedures in place. C. Temporary staff assignments by an audit firm to an audit client are permissible. D. An audit firm must not perform a professional valuation of an asset for an audit client if the asset is material to the financial statement. The answer is A. Responsibility for internal controls must remain with management of the audit client, and management of internal controls must not become the responsibility of the audit firm. Question 3. If a member of the audit team owns shares in a client company, what sort of threats to independence arises? A. Self-interest. B. Self-review. C. Advocacy. D. Familiarity. The answer is A. The auditor might be motivated for the company to report high profits so that the value of its shareholding will increase. It therefore has a self-interest in the audited result of the company. Question 4. Which of the following are fundamental ethical principles for professional accountants? 1. Competence. 2. Compliance. 3. Integrity. 4. Objectivity. Option A. 1, 2, and 3 only. B. 1, 3, and 4 only. C. 2, 3, and 4 only? D. 1, 2, and 4 only. Answer is B. The 5 fundamental principles are integrity, objectivity, professional competence and due care, confidentiality, and professional behavior. Question 5. Which of the following are threats to the independence of an auditor? 1. Loans between the auditor and the client. 2. The provision of non-audit services by the auditor. 3. Long association between the audit firm and the client. 4. Using the work of the client's internal audit department. Option A, 1, 2, and 3 only. B, 1, 3, and 4 only. C, 2, 3, and 4 only. D, 1, 2, and 4 only. The answer is A. As long as the external auditor believes that the internal audit is technically competent and operates with due professional care, the external audit can use internal audit work. No threat arises to the external auditor's independence. Now we've come to the end of chapter 3. Thank you.